world headquarters in New York, to our television and radio audiences worldwide. Welcome to Balance of Power. Well, yesterday was CPI numbers.
Hello to all of you, and welcome. Lovely to have both of you, Anthony and Garth. Thanks very much for having you guys online. Zoom gave me a little bit of an interesting feature tonight, which is where we're already live. Normally we have a room and then we let people in, but tonight we're already live. So we had a bit of Bloomberg news going so that everyone could have a bit of an update just while we were joining. So anyway, wonderful to have you guys online. I have everyone joining pretty much now. They'll be coming in as we speak around 7 o'clock. We are recording. And where are you both coming from? You look like you're sitting next to each other.
Yeah, evening, Scott. Hi, everybody that's online. We are sitting next to each other because I'm having some issues with the charging of my computer. So anyone who doesn't know, Scott might need to introduce me a few times when I speak. I'm not Anthony Dinham. That's the clever one to the right of me. And I'm Garth Wellman. And yes, we are sitting together in our Houghton head office in Johannesburg.
Awesome. Well, I'm going to do a proper introduction now. I just thought it'd be nice to get you guys online. So look, to everyone else that's joined, let us know whereabouts you are coming in from. We've just finished a mastermind, funny enough. We had people from all over the world. So it's always fascinating to see where people are coming from. Always great to understand. So we've got Costa Rica. We've got the UK. Let's see. Stellenbosch. McGregor, Jersey, Zambia, Italy, New Zealand, Pretoria, Abu Dhabi. Wow, Durban. You certainly got a fair range of countries here. Awesome. Well, thanks. If anyone else wants to let us through. So without further ado, I want to get straight into it. Let's rock and roll. If you've got questions or Q&A, then put them through. And Cooney, the President Mandela's birthplace. So that's pretty cool. So what are we doing tonight? Or today, or wherever you are in the world, depending on your time zone, if you're watching the recording. We're doing a 2023 market review. What do the top 1% already know that we believe you should know? You know, I think we live in very interesting times. Last year we had, still going, the Ukraine conflict, you know, inflation, 40-year highs, interest rates rising no matter where you look, you know, petrol price and energy prices going up all over the world, the stock market in interesting times. And if you live in South Africa, if it wasn't interesting enough already, we've got load shedding. One of the things that I think is very important when it comes to investing is all around your mindset. Often in tough times, people get caught in an away state with withdrawn, fearful, inability to make good choices, demotivated. It's very important to be in a towards state. So one of the purposes of tonight is to give you, you know, interesting information and knowledge and to help you remain in a towards state so that you can take advantage of where the markets are going. And then the last thing I'd say on this is that often people get caught up in problem and drama. It's a bottom-up approach. Something that I take our diversification mastermind people through on a consistent basis. It's very important to get clear on your outcome. And once you got clear on your outcome, you actually work backwards. So the first question I've got for everyone is, who here knows what a family office is? Just type in the chat box. Tell me if you know what a family office is. If you've heard of a family office, just you can write yes or no. I'd be interested to know whether people actually understand what a family office actually is. So I've got yes, no, lots of yeses. Okay, a bunch of no's, new term to me. Okay, so what I wanted to share just very quickly, so I don't want to assume that everyone knows what I'm talking about. Investopedia, I went and did a quick search today. So Garth and Anthony, you guys can tell me if you agree with this, but a family office is a private wealth management firm established by an ultra high net worth family that provides that family with a selection of personalized services that include investment management, financial planning, estate and tax planning, philanthropic investing, concierge services, and more. And then who needs a family office? Since family offices can be very expensive to establish and operate, only the extremely wealthy who have complex financial investment and personal needs usually require one. One estimate is that only individuals with a net worth of $250 million can afford a dedicated family office. So I'd love to know, Anthony, just from your side, I'm going to introduce you guys properly, but you and I spoke a bit about a family office. Would you agree with that? Does that make sense? Or is there anything that you would add or detract from Investopedia?
Yeah, look, I think that first paragraph sums it up quite nicely towards the end of it. I would disagree with the kind of opening statement that it's established by an ultra high net worth family. I don't think that needs to be the case. But yeah, the rest of it, the services side, I think those are boxes that we definitely tick. So yeah, I would agree 50% with what it's saying.
Brilliant.
So I'm going to jump in, if you don't mind, Scott.
Please do, Garth.
Okay, so 100% that is what a family office is, and Anthony's right. It's not exactly what applies to us. So in the Wikipedia sense, a high net worth individual sets up a family office almost like his own personalized administration, financial wealth management service. So what Caleo established itself as, and what's incredibly important, is to add multi-family office. And what that did is it took a very expensive, very unobtainable need to families that didn't have 250 million, okay, but consolidated several high net worth families to build a portfolio of $500 to $1 billion, and all received the service. So what we do is we keep it consolidated, all right? So we're not just managing one family. We keep it consolidated to a small high net worth group of families. So it's spot on for a single individual family office. We are a multi-family office consolidating the services of what is listed there, just to give a bit of clarity around it. So yeah.
No, perfect. Thank you very much. Why I wanted to start here, because I was about to explain that you guys are a family office, and I didn't want to just assume that everyone knows what a family office is. So I think it sort of leads me very much into the next slide, which is all about Caleo and, you know, the fact that you are a family office. Garth, you've just explained what it is. I love the description that you've actually got on your website around what the partnership is that you go into with families, how it actually works. And I'd love you, Garth, just to explain a little bit more from a Caleo perspective. And as I said, wanting to introduce Garth, I mean, he's basically one of the CEOs and co-founders of Caleo. And as you can see there, you know, there's a whole range of things that he's involved in. So, you know, is there anything, Garth, with regards to add to what you just said around that multi-family office? Because I think it's critical that people understand that generally only sort of the top, you know, families are getting access to these family office constructs.
Yeah, so I mean, before we go into the concept of what drives Caleo, which is a symbiotic relationship, for us, a lot of what drove us going in the direction of a multi-family office was to get away from the single product offering of an institution. And what was covered in that Wikipedia description is very important, is we are able to source anything, everything, and be unbiased in what suits the investor or the family. So when we look at Caleo, the family office, the multi-family office was set up to look after those which are wealthy. But if you go to the bottom there, you'll see we also offer wealth management, which borrows from the family office's expertise to create wealth and good financial behavior. Asset management for a person just looking to make a single stock portfolio purchase, for example. Private equity, an asset class which was very hard to access in this country. We created a private equity firm that could research and bring opportunities. And then, of course, the global banking. So that bottom statement there, the family office uses a lot of those specialized services to source, but we're an agnostic firm. We don't sell a Caleo product. We provide family office services to source, okay, what that family needs, what that investor needs. And most of that is information-based to achieve an outcome and not drive a product or a particular fund or a particular investment program that we have at any one time. So I think that's the big difference of what we do. And that's encapsulated in the first statement there. But I would say it's really focusing on a symbiotic relationship as opposed to what might be unfair in some circumstances, but can be parasitic. And a parasitic relationship is where an institution is looking to make money out of you. A symbiotic relationship is where we make money together as partners.
Love that. Symbiotic relationship versus parasitic. So the last thing I just wanted to ask you, Garth, before I hand to Anthony, when I met with you, you said something along the lines, it wasn't exactly verbatim word for word, but you said something along the lines of, was that, the 1% can pay for the advice and get the results. We need to support everyone else to get access to the same advice and results. And you've kind of alluded to it already with the wealth management and the asset management, etc. But I think it's quite important that people just kind of understand that driving kind of purpose that you mentioned, because I think it's quite important that people get, because otherwise they say, well, it's too good to be true. Why are you guys here tonight?
Yeah, I never said that. I'm joking. Yeah, I use a derivative of that quote quite often. And that's the problem. One thing that's happened in the industry since 2008 is it's become incredibly restrictive, compliant, and very difficult for people without high net worth capital to get access to good advice. And that's a problem, because if you don't get good advice, you have a bad experience with an advisor or a bad experience with an investor, and it taints your relationship. And then a person never enters that world again. So one of our big driving forces, and I think it's probably the purpose that I get up in the morning, is to try and reach as many people through as many media platforms, through as many mechanisms as possible to provide information. Okay, because if we don't do that and we only get to the 65 families that we run, those mistakes will continue to be made. The cost of trying to get advice from the people that are looking after the family offices and that is just too expensive. And that's the problem with the industry. The haves can get it, the have-nots can't. So I think a lot of people are driven by the purpose to bring in financial coaching, to bring in good behavioral finance. And, ultimately, Caleo, and I say this unashamedly, really is focused on a much bigger outcome for people, both through investments and through education. And when I say outcome for people, right down to impact investing, which is a strong theme in everything we do, and ESG investing, where we spend a lot of time on really not green dressing, but providing proper environmental, this is the acronym if you don't know, the environmental, social, and the governance around the 17 principles that come out of the United Nations, so that we can assess companies. And that's really what we're saying. We want people to make impact investments. We want people to make money consciously, and we are conscious capitalists looking to partner and educate. Whether you can or you can't afford it, people should be educated in the realm of making great investment decisions. And that's one of the reasons, Scott, you and I have spent a lot of time over the last 9 years partnering. It's because I've been driven by that need to educate and bring that information. So I think, I think that quote there is very important.
Awesome, thank you. So Garth, I think moving to yourself, Anthony, one of the things that I've been impressed with yourself, Anthony, was the conversations that we've had and how you and Garth work closely together and help, different clients. You're associate partner. I don't know if you just want to introduce yourself so that everyone understands who you guys are, and then we're going to get into the meat of the webinar.
Yeah, sure. Thanks, Scott. Like it says, associate partner. I've been at Caleo now for about 6 or 7 years. Really, a lot of my focus lies, it's split, I guess, between the family office and the asset management side of the business. Strong focus with Garth on markets and allocations for clients, as well as this kind of softer, more relationship side with clients. That's really where I fit and I kind of bridge that gap.
And he's a brilliant analyst.
Awesome.
Yeah.
Well, that's a pretty good way to kind of segment into tonight's webinar. So just to remind everyone, tonight we're not giving you financial advice. We're purely giving you our opinions and our information and knowledge on the market. But you must still do your own research, etc. It is important in terms of that overall process. So the first question that I wanted to kind of jump right into, and I actually shared this with people that are part of our mastermind and our wealth hackers, but I got access to all the different top kind of links, okay? And I know, Anthony, something that resonated with me a lot was that you said, look, Scott, we get access to kind of the top banks reports. We manage $600 million plus minus just short of 10 billion rand, if I've got my maths right in terms of the overall process. And we get access to this knowledge, and then we synthesize it in terms of what is happening. I don't know, Anthony, if you just want to talk to that process, because most people, even though I sent everyone these links, don't even have the time to read 19 different reports, and more importantly, to even figure out what to do with it, you know?
Yeah, no, sure. This is a comprehensive list. Believe it or not, our list is probably a bit more comprehensive than this. But really, like you say, Scott, it's about digesting the information, and it's about understanding where each different research provider is coming from, what their motive is. It's a very strong thing to consider, and I would kind of urge anyone that looks at these things to try and understand the motive of the research provider, because you can sometimes come across research that's a bit tainted when guys try and push their own agenda, and believe it or not, it happens in the banks, it happens everywhere. So for us, it's about digesting, it's about understanding the different points of view, and then using our own knowledge and kind of finding a middle of the road that really encompasses is everyone's view. So that's what we like to do. Like you said, it's a lot to wade through. But you generally start to pick up these themes, and you'll start to see, is everyone aligned with one direction, or are we starting to get some divergence in those views, which really signals to us potentially tread with a bit of caution. When one guy's saying buy, other guys are saying sell, you need to understand why.
So that exhaustive list that you put there, interestingly enough, Anthony read probably all of those reports. And whilst he was enjoying his New Year party, I sent him a message to say, please summarize all of those reports, have a look at them and find the common points and give us a synopsis of the theme, which he did. And we actually sent out in January. So we have read a lot of those reports.
No, and I think that's the whole point, Garth. That's what intrigued me when Anthony mentioned it. And that's sort of where I want to start. And Anthony, I've got those graphs available. You must just shout when you want them, the different graphs that you sent me. But I'd like you to kind of, and whether I've taken the screen sharing off on purpose so people can actually see you better. But my point being is that, what is the synopsis of the market conditions for 2023? What are your kind of takeaways, etc.?
Yeah, good question. $1 million question, I guess, at this stage. I think for me, it's important to understand where we've come from to kind of paint a better picture as to where we're going. So a quick recap, the last 10, 15 years have been an environment of extremely low interest rates and low inflation, which favors some companies more than others. And we've seen some companies do extremely well. I mean, just take a look at some of the FANGs, which is your Facebook, Apple, Netflix, Google, and just see their share price or their return over the last 10, 15 years. I mean, it's really been astronomical. We then kind of entered this COVID environment where there was a lot of uncertainty in the markets. The US dished out massive stimulus checks. And again, it was a drop during March, and it was off to the races for the rest of 2020. Now, a lot of these things have long-term implications, and it takes a while for this to kind of wash back into the markets and really for the market to digest and for the indicators to start flashing red. And this really all came home to roost in 2022. We had high levels of inflation. We had interest rates that were low that really needed to start ramping up to control this inflation. Throw in a war between Russia and Ukraine, and you've got quite a big recipe for disaster. I mean, add China lockdowns to that, and that kind of never-ending story throughout 2022. And you're really starting to paint a kind of perfect storm. So that happened in 2022. And the reason why I bring that up is because those are all important risks and factors to keep in the back of your mind when looking at 2023. We saw an interesting start to the year. Certainly something that I haven't seen in a very long time. You had December, quite a bad month for markets. I think most markets were down around 6-7%. And then you almost had first, second, third of January, this complete change of switch. And guys, it was almost like they came back from their Christmas holidays and they completely forgot about 2022. It happened that fast. We saw markets gathering steam, some really good upward momentum, and January finished positive. So a lot of guys were left kind of scratching their head because there was no real data that came out that was super bullish or anything that was screaming buy at the time. There was some positive news out of China, which I'll chat to now. But really, that's the kind of environment we find ourselves in now. So looking forward, we would summarize our view as cautiously optimistic. There are definitely some serious risks that are still on the table, but there are some good green shoots starting to emerge. Probably the biggest one at the moment is that China has seemed to come out of their lockdown. They're back at the office, they're back in the factories. That wheel is starting to churn again, and we're getting that supply to the rest of the world that we so desperately needed. So a lot of the inflation that we saw throughout 2022 was what we call supply side inflation. And really what that means is that there's not enough goods to go around for people to buy. So they end up getting into almost a price war, trying to bid on, let's use a loaf of bread as an example. They get into a bit of a price war trying to buy this loaf of bread, and that drives prices up, and it's not good for inflation. So that's one of the risks that's washing out. That's a good thing we've seen. I think the attention for us is definitely on quality businesses that can withstand any potential volatility or wobbles further down the road. When I say quality businesses, I mean those that are cash rich, that aren't running large balance sheets with a lot of debt on them. Debt at the moment is obviously starting to become extremely expensive when your interest rates go up. So you want to see companies that are healthy, companies that are paying a dividend, even if it's not a massive dividend. What it tells us is that if there are any storms down the road, those companies are able to withstand them a lot better. They can slash dividends. They're not going to have to dig into debt and things like that. So that's where the focus is on quality businesses that are sustainable, businesses that have high economic moats that aren't easily disrupted. And then if we move into other asset classes, I mean that largely focuses on equity. If we move into asset classes like bonds, coming off an absolutely shocking 2022. I mean the stats are at a stage where I think the worst bond market are out in about 70 odd years, which is saying a lot. So there's definitely value there. Property's looking good at the moment. We're seeing some good yields in that sector. So yeah, it's a stock pickers environment. It's certainly moving more towards an active management style of portfolio management. What I mean by that is really you need to have guys that understand these businesses well, that can kind of cherry pick for you. I think whilst the indices will still do well, I think an active manager can do even better. You got to remember that these indices by definition are just loaded with, let's use the S&P 500. They've got the top 500 companies. So you're not getting that active manager that can overlay a sense of analysis into it. So that's where our mind's at, Garth. I don't know if you want to add to that.
No, I think you've covered most of the themes. I mean, I would talk on a more generalized level later on, but yeah, I think that does give us one thing I want to mention. I mean, that slide you put up is actually brilliant, because we get so focused in what is the 2023 outlook, and the one, if you go back to the emotions, Scott, right in the beginning where you showed negative emotions around markets and that. And I just want to talk about this because this is what we face. Now, you must know when you have a 2022, that threat, that side there, an investor becomes an 8-year-old child in a supermarket that can't get the toy. It's almost an irrational, no matter how much he logically can, source the information. That's where they go straight away. Now, when you have a January with all the information flowing there, you've got to be very careful of what we call false starts. So now in January, you've got everybody who in December was on that side, and now everybody on the right is going, the world's changing. So, and when you look at those, all those economic reports and outlooks that you put there, you've got big banks, big research banks, one saying 100% is going to be a bull market. You've got another saying it's going to be a deeper recession than we think. So to summarize what Anthony was saying, we've got a recessionary environment, but what we are analyzing and what we are seeing as an outlook for 2023 is that this recession that everybody has been fearful of has been a much softer landing in January, and we believe that softer landing is going to carry into the 2023 theme, that volatility will remain, but don't for 1 second believe that the problems are gone. So we believe the soft landing, the inflation, the interest rates, all of the mechanisms to drive a bull market are going to take a little bit longer than people think. We're only going to see inflation, predictions coming down in 2024, in our outlook on inflation. So a lot of the stuff that we see is going to unfold in the latter part of this year. And when we talk about a soft landing on the recession, and when we talk about, cautiously optimistic, what does that mean? And when we bring up that asset class chart of ours and we look at the actual numbers of how some of the assets have fallen, you get kind of this, the world fell by 20%, 18 to 20% in dollars last year. And
Guys,
we believe...
Will you guys just tell me when you want those slides? Because
we'll bring it up when you talk about the asset allocation side. But we actually feel that we're not going to see those all-time highs. And I want to make that remark again. This is not advice. This is a view that we would build portfolios on. So our view is very much that the emotions will drive volatility. The general sentiment is not like as positive as people think it is. There's still a lot of negative sentiment. There's still a lot of concern, and there's still a lot of themes to play out. So looking at the global benchmark, the MSCI, for example, we're quite confident, even with the very strong start, that the world is likely to produce 3/4 recovery of the loss that it had. So I'm talking if the S&P 500 was down 18 or the MSCI was down 18, we expect 10 to 12% positive returns, 3/4 of the recovery, if the current themes continue to play out like this. And we see inflation actually really being under control, which we believe it is. And we see that outlook for 2024, the inflation numbers dropping, but global GDP remains very muted. And it's in that we see the sectors of opportunity. And why I bring up that graph of emotions is what takes you from the red zone back to the blue is not worrying about what actually is going to happen this year. It's by having a proper financial plan. It's by having proper insight to see the opportunities and being able to think clearly about the long-term plan. Okay. And that's where you remove temporary and damaging, behavioral finance decisions. So that's just a caveat I want to add to when you have an outlook of 2023. Yes, there's opportunities, but those must fit your plan. They must fit the family that we are managing. It must fit one of the several portfolios we might have in there. So yeah, I'm just bringing that into context as well. Sorry, I was a bit long-winded there.
No, I love what you just said there, because I think it's absolutely critical. If I've learned one thing in 25 years, again, it's not this panicking up and down. It's like, what's your long-term plan and kind of sticking to it. So I'm very glad that you reiterated that in terms of that process. So let's move on to the second question. You've sort of alluded to it already, Anthony, and so you need to kind of help me here if you think you've covered it or whatever. But you've kind of spoken a bit to, the equities market, the bond market, and the property market. Is there anything else in terms of markets and maybe now this would also involve kind of countries, the difference between the US and Europe and stuff in terms of different markets that you would be looking at?
I think this is a great time to pick up, bring up courtesy of JP Morgan, the asset allocation returns in that.
Gotcha.
Yep.
I'll get it. No, I got it for you here. This one.
Yeah, that one. Yeah, so I'm not sure whether people are going. Okay, they should be able to see it. So Anthony's going to talk to this, and this will talk to countries and everything. Now, bear in mind, it would have been wonderful to do this on the 1st of January, because we actually would have looked like geniuses in January, because our predictions in January that we made around what to position in that were made off, and we've always been very, this doesn't change, guys. Asset allocation, and this is not all of the asset classes we work with, but asset allocation is going to account for 85% of your return and is the fundamental building blocks of asset management and a financial plan that's going to, produce income or anything. But Anthony's going to talk to this, and this will give you very specific kind of views around the returns, the averages, and where we think the value lies.
Sure. All right. So what is this? I mean, this is quite a busy chart here. But really what this is saying, and it's taking you back to 2008 on the far left and ending on 2022 on the far right. And basically this is looking at the major asset classes, and it's basically showing the return for that year. Now, this is something that we pay close attention to. Don't get me wrong. We don't solely base our decisions on this heat map, but it gives us a good starting point in what to look at. So you'll notice everything has a color, and it's quite easy just with your eye to kind of follow where and how each asset class has performed over time. So you'll notice pretty much off the bat that there's quite an obvious trend in the sense that these colors kind of move to the top and then they kind of trickle their way back down. So really that's what we're looking for. We're looking for that trend. So I mean, if I can take 2018 here as an example, it's a color that stands out to me as this light blue, the REITs, which is real estate investment trust, which is essentially your property plays. And you'll see that goes from where the cursor is now, it trickles all the way to the top. And then it's in 2022, it's literally the worst performer. Now, you can do this with any one of the colors, but you'll notice, I mean, it's not a perfect science here, but you'll notice this kind of trend where it trickles to the top and then it trickles its way back down. And really, that's just the different cycles of the different asset classes playing out. Now, when in terms of asset allocation and your mix to these different baskets, you're obviously going to be wanting to favor what you think is going to do well, and what you think is going to recover, and you want to downweight things that you don't think are going to do so well. So really, that's where the initial decision making starts for us. So if you look at 2022, like I said, you'll see REITs here on the back foot, small caps on the back foot, and emerging market equity on the back foot. Both of those have in the past enjoyed kind of top quartile performance, and they've kind of trickled their way down. So that immediately at the end of last year, beginning of this year, starts to get us thinking, and we start to dive deeper into each one of those asset classes. Now, I'm going to ask Scott to just jump to the one that looks identical to this, but it is slightly different. This one, and you'll notice here, whilst some of these names are slightly different, but you'll notice here, this one includes on the far right column, it includes January 2023. Now, as Garth said, in hindsight, this looks like we're cherry picking, but we do this exercise at the beginning of the year, and it's quite rewarding to see some of those lower players starting to push their way up to the top. You'll see the emerging markets growth, REITs, small cap. We touched on them just now at the end of 2022. They were at the bottom. Now they're pretty much at the top. So these are interesting things that you start to pick up over time, and it gives you guidance as to which sectors you should be, or which asset classes you should be paying more attention to. So really that's how we start to kind of screen, and we start to look at these different asset classes, and then obviously we dive a bit deeper into them. And again, going back to what the client is trying to achieve and what the financial planning is telling us, we then start to cherry pick in the sectors. Again, assuming that someone needs or wants to run an equity portfolio. It's not the be all and end all. There's plenty of other asset classes that we can use to achieve goals. But I think this is probably the most widely spoken to is the equity space.
Awesome. So let me run to the next question that I had, and you know, forgive me for, I'm going to ask the silly questions on behalf of everyone, but if you were to say your top three sort of assets in 2023, what would they be? Are they the top three that are there, emerging markets, growth, and REITs, or what are you saying to us in terms of the assets to look at?
I'll jump in there. Looking at the asset classes, again, if you go back, you've got to be cognizant of the annualized returns that an asset class can produce. And then you've got to be very conscious of that volatility. Volatility equals risk. So you'll see that your risk on the far right-hand column, your volatility goes from the bottom to the top. So the REIT in the annualized return, real estate investment trusts produce the third highest consistent average return, but they produce it at the highest volatility. Small caps, okay, have the second highest volatility and the second highest return. Emerging markets, third highest volatility, and then you get down to that one where you've got asset allocation producing the fourth highest return, annualized, but the third lowest above cash and fixed income. So portfolio construction is about getting the highest return at the lowest risk. So this comes with a big risk warning when I say what we see, because this is very dependent on how long your outlook is. But all of these, and if you go back to the graph that we've just been on, move away from this one, you look at the volatility involved in an asset class. We believed at the beginning of the year, emerging markets, because of the very low base, they were very cheap, emerging markets would have a strong year. We still feel that emerging markets can have a strong year. We feel that developed markets might struggle a little bit. Okay, there's your developed market equities in the middle there in January, had a pretty strong January, but coming off a low base. So we feel on a 3 to 5 year, which is the equity cycle, that buying the small cap space now, for example, and selling the commodity space, which we would have done. Now, the commodities can still run, but if you look at, the commodities average return, we feel that commodities, whilst it can still run for a while, is starting to reach sell territory. All right. So in any portfolio, let me make the caveat that there's a geographical exposure to these asset classes. That's very important. We would still hold, because of the ability for the American machine to protect itself from recession, we would in a portfolio still hold between 50 and 60% of the portfolio in the USA. Okay, so that's where it's quite important to understand a real estate investment trust, but in what geographical sector. So what these heat maps tell you is what is cheap and what is expensive. And when we looked at 2022, if you had said, hold on, commodities are looking expensive, in 2023, they're probably not going to have the greatest year. Well, they had the worst January. And then emerging markets, the MSCI emerging markets, we would have said was a buy. And in our research, we would have said that in 2023, this is an asset class to own. Well, it proved itself in January. Now, what's important is we view that comment I made around the markets are likely on a cautiously optimistic outlook going to produce 10 to 12% return. Now we start looking at, hold on, but historically emerging markets, small caps are a little bit behind the curve. We believe those sectors can produce higher return than the average. So we would believe that small caps over a 3 to 5 year period bought now will have a better year and possibly do 15 to 20% because they were down, 30, 40%. And that's how you've got to construct a portfolio. But the percentages are critical. So we see value in emerging markets. We see value in oversold growth shares, tech shares, for example, which, had a very strong January, for example. So yeah, that's really what we're saying here, where we see the sectors is, more towards lightening on the commodities, more sort of towards emerging markets, but you're not going to go 90% into an emerging market in a portfolio. It's got massive volatility. But real estate investment trusts, for example, have had a very long, sustained negative period, but because of the income portion of it, it's going to go back. what is important about the other graph is you look at times of high interest rates, 2008, times of panic. I think fixed income and cash at the current interest rates will still hold a lot of the investment capital for the portions of this year. So like you can see there, 2008, you've got a big fixed income and a cash holding, and you see in 2009, you're starting to come out of that, the search for yields going to emerging market. So there are factors and plays around, the global financial crisis that will play out in any, bear market. And I think that's why we're still going to see, fixed income and cash holding a higher position in the markets this year because of how some of those things got damaged last year. So it's quite non-committal, and I'm letting people read into that with the, the caveat that the right percentages are critical. Okay.
Yeah. Just a quick one, Garth. You mentioned sort of any portfolio would have 50 to 60% in America. And I know it's a broad brush, and I know it's, dependent on each person and all that sort of stuff. But if you would take 100% and you got 50 to 60% in America, where else should you be looking if you were diversifying around the world?
So there, you're looking at portfolio principles again. So, I'm talking about the equity component at 50 to 60% in the USA. All right. Now I'm just taking the equity carve out. The remaining portions of that, you're going to look at the highly discounted. This is where Anthony, as a portfolio analyst, will come in on the construction of these things. So let's say you've got 60 to 65% in the USA. We believe that machine can stave off inflation a lot better. We believe it's got a lot of the digital stocks. We believe it's got a lot of the, the stocks that are really big companies that can also, deliver. So that's why we go with that US equity carve out. But your emerging markets, right down to developed markets in percentages of 3%, emerging markets probably hovering closer to 5 to 7. If you drill into the emerging market carve out, that's also very important because you're not going to exactly be jumping up and down about Russia at the moment. So you're going to be looking at, your Asia ex-Japan, China, for example. We believe China has got long-term issues, long-term demographic problems in the population. But we're quite confident that China's got some way to go in terms of stabilizing its economy. It's forward-looking, GDP is hovering around 4.6 for 2024, 2023 marginally higher than that. So, you're looking at all of those carve-outs. So we would be quite light on the UK, on the Eurozone at the moment, a little light on the UK, probably increasing those after we get direction. And then Latin America, some allocations there are important to us. But that kind of gives you, the depth of diversification, the Australasia region, we would also favor in terms of infrastructure, some of the stuff that's coming out of there. Yeah. I mean, if that answers your question, Anthony, I don't know if you can answer that.
Yeah, I think it's hard. I think Eurozone is becoming a slowly but surely it's becoming a bit more attractive, and a thesis is definitely building up towards them. They've come out of a very tough 2022. The start of this year they were pretty much rock bottom. And when I say Eurozone, I exclude UK, as UK held up actually quite well last year. But yeah, they're looking at a bit of a turnaround there. They had a winter that wasn't as extreme as they thought. So all of those kind of gas supply and those risks washed out fairly easily. So they were lucky there. That was very, very lucky. So a thesis could be made there. Like Garth said, China is starting to look very attractive at the moment. Again, that's not something where you just kind of throw all your eggs in one basket. That's an incredibly challenging region, and that needs to be managed by a professional. That is not just a kind of blanket ETF play where you kind of hope for the best. It's a very, very intricate market that needs to be understood by someone on the ground. But there is value there. Again, they're coming out of pretty much the worst environment they've been in. They've been in lockdown. They've had policies slapped onto every single asset class or every single sector of their market, which has really caused them a lot of pain, especially in the tech space. So they're looking attractive. Yeah, and then all the other kind of ancillary regions that Garth mentioned. But yeah.
Tommy, in terms of risks, you mentioned one of them, and what I heard you say, Garth, is not making sure that, not having the right information, and in terms of advice, portfolio construction, et cetera, and that sort of, I just want to point out what I wrote down here. You said 85% of your return is going to be based on asset allocation, so it's quite important just to highlight that. But what are sort of 3 or 4 of the other risks that you think that people need to be aware of, or investors need to be aware of?
Information overload, short-term commentators pushing agenda. I know that sounds like a strange risk because we're actually talking about economic risk and things. Yeah. So that's one of my comments. A lot of your plans can be derailed by the guy on the radio on the way to work in the morning who says, something along the lines of, if I don't give my client 20%, he's marketing an agenda. So you've got to be very careful of greed, okay, and believing that the fundamentals will be different. Okay, they don't change, and no amount of analysis actually changes. All that's happening in our day and age is that information is moving very quickly, and it's changing the sentiment very quickly, but the macroeconomic fundamentals driving the world are very simple. So be careful of too much information. And if there's one thing people must understand is when things are more expensive because of inflation, there's less money to invest. That means a person's going to buy what's essential, which translates to those companies that produce essentials are going to have a solid delivery. So not to break the rules of investing, okay? And to be aware of the changing planet. A lot of people have entered the investment markets over a very different cycle of quantitative easing, super low interest rates, super low inflation rates. This is the market that I know and understood pre-2008. And Anthony alluded to it. Be careful of, it all comes down to breaking the rules, but we are in a very different environment. And when we look at average returns, the risks you've got to be careful of is thinking that 30% is what your return should be annualized. Please understand, real returns are great if they're 5 to 7% above inflation. Those are stellar. But as inflation is higher, it still remains 5 to 7 above inflation. So the risks are unrealistic returns, okay? Influences are very fast-moving things that we've got used to that delivered massive returns. You've got to be realistic about returns. And, that's what Anthony spoke about. Active management, people being able to analyze real macroeconomic cycles that we're back in now, and being able to shift from what is expensive and what is run, and being able to pick out of the S&P 500 where, for example, the opportunities exist. Or like, our asset manager in China that can buy real companies and real pockets rather than just the thing. So you must do your research. You must speak to seasoned professionals. You must be very conscious of costs, okay, in investments, because the margins are going to get tighter. So you should be conscious of investment costs. You must be conscious of, do not enter anything that charges you upfront to allocate it, because a reduced capital, be it tax or a commission or an upfront, is extremely damaging and so expensive over the long term. So try and get the highest net allocation to an investment, be realistic about the returns, understand what that asset class can produce. That's just the behavioral risk that I'm talking about. Anthony can talk about COVID risks, China going back into lockdown. I'm going to let him talk about some of those other risks there. Okay.
Sure. I would add one softer risk to that as well. Is is just the risk of not understanding your investment goalposts. And what I mean by that is you might find yourself in a situation where you can sustain yourself against your liabilities, and you take on undue risk because you don't quite understand your playing field. You feel you have to go into equities because everyone talks about equities, but you may not need to go into equities and have that kind of risk in your portfolio. Your portfolio might be able to sustain you without taking any undue risk. So I think it's important to understand your playing field as well. On a slightly more technical side, I think people need to keep in mind that the yield curve at the moment is inverted. It's traditionally been an early telltale sign of a recession. So that still exists, whilst the market seems to have forgotten about that as we hit the 1st of January. It's still there, it's still inverted. So be careful of that. Inflation numbers came out last night, slightly higher than expectations. They were down year on year, but there is a bit of a nastier, stickier side to that inflation that people are I wouldn't say they don't want to acknowledge it, but they're hoping it's going to come down. But if it doesn't, it could cause a lot of volatility. And then my third risk, I could probably talk for hours on this, but my third important risk would be understanding the interest rate cycle that the Federal Reserve is currently in. So the guidance was initially, guys have been pricing in the market that interest rates are going to be cut in the US by the end of this year. Our house view on that is that's quite, I think it's a bit premature. I think it'll probably start to happen next year. But really what that creates is it creates volatility in the market because everyone's just trying to plot and forecast when these rates are going to come down. So I think a sustained period of higher interest rates is something to be cautious of. It's definitely a risk. Yeah.
Sorry, I'm making vociferous notes. I hope everyone else is. It's so much information. Yeah, I just keep thinking to myself, cross, I'm gonna have to watch this again to understand half of what you're saying. Tell me in terms of, I know you got 2 other slides that you wanted to share, and I'm conscious of time here. I want to sort of wrap up on the hour. In terms of, and then we'll move to our VIP room for the FAQ. But we've got basically the kind of the 3 questions I had here was kind of where do the opportunities lie? I think you've probably spoken about that at quite a lot of length. Anthony, I just don't want to make sure I'm missing those 2 slides that you had. So you need to tell me if it's related to that question or the next one, which is there an overall strategy that investors should be focusing on? And my third question was, what can we copy from the wealthiest investors? So I kind of going to ask all 3 of them, and you can kind of relate to what you think and those 2 slides that you asked me to prepare as well.
I want to jump in on the private equity side here because it's something which is so important in family office portfolios. Now, when I say private equity, I'm talking about unlisted investments and opportunities, into, this is the one I'm looking for.
Yeah.
Opportunity. This is investing into direct opportunities. Okay. Now, this is an interesting graph because one thing about, I would say 85% of our clients is they were entrepreneurs, they built big businesses, they sold big businesses. So they understand business, and many of these people are interestingly quite kind of great entrepreneurs are not great investors. I've said that many times. Okay. And there's a whole reason for that I won't get into tonight. We can do that in the psychology of investors. But what this is showing, when you talk about opportunities, I think private equity is such an inaccessible asset class for so many people. Okay. It's either very difficult to enter private equity because 1, the ticket size is very large. Number 2, the illiquid nature of private equity is an investment cycle of 7 to 10. Now, previously you went into it, it was 5 to 7. I've never seen a good private equity portfolio play out and deliver its returns in 5 years. So private equity is really something in the wealthy families. And this answers that last, what do wealthy families do? It's why family offices are the first people approached by new venture capital businesses, by business opportunities. Family offices are invited. And we are regularly invited as a multi-family office to bring investors to opportunity, which gives us a massive, competitive advantage in that. The fact that we also have incredibly astute private equity managers who are able to bring that to a market, all of those opportunities. Now, when you look at this graph, what I'm saying here, this graph shows you 3 scenarios at the top. The first scenario says I had 30% in bonds, 50% in stocks or listed equity, and I had 20% in private equity. 90% of high net worth family offices, 90% of high net worth investors have strong allocations in private equity. If you don't know what private equity is, it's just companies where you're getting access to more concentrated risk and return. Those portfolios that held 20% delivered much higher returns over the period. As the private equity allocation goes down to the more traditional just financial markets and listed market space, you see the actual returns of the portfolio drop. Now, the falsified environment with quantitative easing was the first time in a decade that the S&P 500 performed as well as private equity. So one of our biggest opportunities, we believe forward-looking, is going to be the inclusion of private equity in a person's portfolio. Now, we live in a beautiful digital age where people have created fractionalization of private equity and ways to access private equity. But don't break the rules. Alternative investing and going into private equity goes back to exactly what your definition of risk management was. Analyze, understand, have a good manager, understand your costs, and most importantly, understand the patience required to get these higher than average returns. But we feel in the next decade, private equity will outperform, the financial market significantly. Now, that's a change in the generation of people inheriting the wealth. Conscious capitalism, people looking to control the investments, where their money is going, the impact that they're making, and that aligning to their views on how the world needs to be managed. And this is why we believe private equity is going to get even stronger, because given a portfolio of fracking or oil and gas or fossil fuels, and a person who is inheriting wealth in a generation of highly conscious investing, the listed market is not going to have the traditional allocation, and the impact investing company, the company that's putting up solar as an alternative energy, is going to get the money. And we are able to balance conscious capitalism and returns, in that changing market by having a huge amount of concentration. So I just wanted to talk to this slide about the power of private equity as a future opportunity, on the understanding that it's a very illiquid asset class, What we have done about that illiquidity is to look for a portion of the investment to be structured as debt. So a person is earning an income as well as getting these extraordinary higher returns over that period, which makes it easier to be patient. And if you can derive, and Scott, the property game really well historically. If you can derive a cash-on-cash return, but you have that income, the game I'm talking here. So property, private equity, for example, is just a direct investment into property. So we believe constructing that and having that 20%, between 10 and 20% in a portfolio is going to make a massive difference to your compounding returns. I'm going to let Anthony take over after that and answer some of the 3 questions in one as well.
Sure. Yeah. I don't know if you want to fire away at questions we might have missed, Scott, but I think that was a brilliant.
Just to remind you, I think you've covered quite a few of them, but it's like kind of where do the opportunities lie? I think Garth just really went through that, in terms of private equity and what he's talking about. And, really the last 2 were, is there an overall strategy that investors should be focusing on? And what can we copy from the wealthiest investors?
Yeah, look, I think we've touched on it. I think again, this slide pretty much highlights it to a T. It's getting the asset allocation right. We've touched on the various asset classes that can make up what you see on the screen, the bonds or stocks. And yeah, it's about getting that mix right. It's about understanding your goals and where you're heading, how much risk you actually need to take on, and then being conscious of the risks and partnering with someone that can help you navigate all of this and tie it all together. I know we've been talking for a while, but there's a ton more behind the scenes that goes into something like this, and designing these portfolios and creating these solid, robust financial plans.
Awesome. Great. Well, I think that's probably enough. We're sort of on the hour. What we're going to do now is I just want to share some stuff just very quickly with people. Just give me 2 seconds. Let me get my slides back up here. So I just wanted to kind of share that, get my slides up here quickly, if you just give me 2 minutes quickly. So I think what is important is that we've actually got a webinar next week, Wednesday, which is all around diversification and the masterclass and the 5 important lessons. You know, something that Anthony and myself and Garth are working on quite a lot is diversification 5.0, how people can diversify between countries, currencies, assets, partners, time, and ultimately we're running a mastermind in a partnership. And, you know, a lot of what they've spoken about tonight, asset allocation, information, you know, and getting access to that family office understanding is really, really important. And there's a whole way that I'll take people through it on Wednesday night. There's a whole way as to how to do it, what the process is, and how to achieve that outcome. And so if you are interested, you can go along to the link. It's diversificationmasterclass.com, and you can literally go and sign up. And it's next Wednesday at 7 p.m. South African time, 5 p.m. UK time. So without further ado, what I want to do now is, Garth and Anthony, if you won't mind, we're going to close this down. We're going to move over to the VIP room, which is my Zoom room that I've sent you. To the wealth hackers and to our masterminders, we welcome you to join us so that we can have a kind of a private VIP chat. To everyone else that has joined, I just want to say, hope that you've got a tremendous amount of value. I've taken a plethora of notes in terms of what you said, but my takeaway from what you said on everything that was important, Garth, was that 85% of returns account from your asset allocation. And I think that just shows people the power of the last hour and actually getting access to this knowledge, it helping you do your asset allocation, because it's ultimately going to impact you. And that was my biggest takeaway from you. And my biggest takeaway, Anthony, from you was the power of that financial plan. And, you know, even with regards to risk and et cetera, sticking to that financial plan and not getting caught up in the highs and lows of, you know, the market commentary, basically, which is a bit ironic because we started with Bloomberg Radio. So anyway, thank you to everyone who's been online. It's been wonderful to see you, and we will literally see the VIPs in the VIP room. Thanks, everyone. Cheers.
Thank you, everybody.
Cheers, guys.
Pierre, I'll answer your question in the VIP room about crypto.